What's up, investors? Ismail Ray Reyes here, and today we're talking about why the apartment construction slowdown is actually creating a massive opportunity for multifamily real estate investors. While developers are hitting the brakes, smart investors are getting ready to hit the gas. Let's break down why this market shift could be your ticket to serious returns.
Higher interest rates. Construction loans jumped from roughly 3% in 2021 to 7% in 2024 and 2025. This spike in interest rates has made borrowing significantly more expensive for developers. Significantly increasing project costs and risk lead to higher costs, reducing project feasibility and making developers hesitate. Higher costs reduce project feasibility and make developers hesitate because higher interest rates raise costs, reduce feasibility, delay projects, and drive up rents. Pandemic-era rent surges have flattened because after years of aggressive rent hikes, the market has cooled. This slowdown in rent growth has made tenants more cautious and landlords more hesitant to raise rents, affecting overall market dynamics. Developers who once expected 10% annual rent increases are now seeing much lower gains. Return projections have declined significantly, shaking developer confidence and slowing new construction. As a result, fewer apartments are being built, limiting housing supply. This reduced supply may eventually push rents higher again, creating a challenging cycle for both developers and renters. Financing drought means banks are tightening credit because lenders have become more conservative with real estate loans. This cautious approach results in stricter lending standards that limit the approval of new projects. As fewer developments get funded, the supply shortage in housing worsens, which in turn pushes rents higher due to increased demand and limited availability. Even strong developers struggle to get new loans approved because risk-averse banking conditions stall even well-capitalized projects. This makes it harder for experienced developers to move forward, slowing the overall pace of construction. The combined effect of tighter financing and stalled projects contributes to a challenging market environment for both developers and renters. Labor shortages. Skilled construction workers are scarce because there is simply not enough trained labor to meet construction demand. Labor costs are rising and project timelines are extended by 30 to 40% because fewer workers lead to slower builds and higher budgets. Labor shortages slow construction, raise costs, reduce supply, and push rents higher. Material cost volatility. Supply chain disruptions, tariffs, and inflation mean global instability continues to make material pricing unpredictable. Further delays and unpredictability cause budgeting and scheduling to become a moving target for developers. Developer paralysis means uncertainty and financial strain are freezing new builds because faced with rising costs and increased risks, many developers are choosing to put projects on hold or delay their plans. This hesitation reduces the number of new housing units entering the market, which worsens the existing housing shortage. As supply fails to keep up with demand, rents continue to rise, making housing less affordable for many. The ongoing challenges in financing and construction costs create a difficult environment for developers, slowing growth and limiting options for renters and buyers alike.
But here's why it gets interesting for investors. While construction slows, absorption, that's how quickly existing units get rented, is also shifting the market dynamics. The wave of new apartments from pandemic-era construction is still working its way through the system. But once these units are absorbed and occupied, and with virtually no new supply coming online, we're looking at a completely different market landscape.
Dwindling supply. A significant drop in new units is expected over the next 18 to 24 months because with fewer apartments being built, the available inventory is shrinking fast. Fewer new apartments shrink supply, boost rents, and create opportunities for savvy investors. The slowdown means less future supply, tightening the market, because reduced apartment construction limits future supply, boosts demand, and opens opportunities for rental income growth. Unwavering demand. People still need places to live because renters are not going anywhere and demand for housing remains solid. Job growth and population trends sustain renter demand, enabling investors to benefit from rising rents and strong occupancy. Homeownership remains out of reach due to high mortgage rates and prices, so renting remains the only viable option for many. Supply plus demand imbalance equals pricing power. Landlords regain leverage because with less competition, landlords can raise rents more confidently. As a result, reduced competition boosts landlord pricing power, creating lucrative opportunities for investors. Furthermore, limited new construction enhances the worth of what is already built because it boosts demand for existing units, raising their value and offering investors a strategic edge. National projections industry experts forecast 1 to 3% rent increases because experts expect rent growth in 2025 to be driven by limited supply and rising housing demand. This represents a stable positive shift following the recent slowdown in rent growth, as rent growth is set to stabilize in 2025, fueled by limited supply and steady demand. Overall, the market is showing signs of healthy momentum returning since the 2025 rent forecast signals a positive shift with limited supply, fueling demand and pushing rents higher. High demand, low supply markets. Projected rent bumps of 5% or more are expected because some metros could see sharp increases due to extreme scarcity. Additionally, there was a strong rebound in areas with halted construction since development has frozen. Rents are likely to spike faster. Landlord advantage. Higher rents lead to increased net operating income because as apartment supply shrinks, rental income rises, which increases landlord profits and investment returns. Furthermore, limited apartment supply in 2025 will boost rents, increasing net operating income and landlord profitability amid rising demand. This increased rent potential boosts both cash flow and asset valuations, since rising rents improve landlords' cash flow and asset values, making apartment investments more attractive in a tightening market.
Here's what that means for your investment strategy. If you're holding quality multifamily properties, you're sitting pretty. Your existing assets are about to become more valuable as replacement cost economics work in your favor. For new acquisitions, this is your window. While everyone else is scared, you can potentially find deals from sellers who don't understand the coming supply shortage or just can't make it work for them. Look for well-located properties in markets where construction has really started. The key is positioning before the market fully realizes what's happening. Once rent growth accelerates and cap rates compress, the obvious opportunity will be gone. Timing is everything in real estate, and in late 2025, it is shaping up to be a year where the stars align for multifamily investors. The construction slowdown that's happening now will create the supply shortage that drives your returns tomorrow. While developers are paralyzed by high rates and uncertainty, existing property owners are about to benefit from reduced competition and increased pricing power. It's a classic case of short-term pain creating long-term opportunity. So there you have it. Why the apartment construction crisis is actually a multifamily investor's dream scenario. Reduced supply, steady demand, and returning rent growth equals opportunity with a capital O. Developers who can't build today are essentially handing market share to existing property owners. And if you position yourself correctly, you could be one of the biggest beneficiaries of this supply shortage. What's your take on the multifamily opportunity? Drop your thoughts in the comments and let's keep the conversation going. Let's build wealth together, one smart investment at a time. I'm Ray, and I'll see you in the next one.